Well, this is Michael Douville. It is January 8th, 2021. As you know, I'm in the real estate business. Most of my friends are my age, and 85% of my friends are broke. Now, they're not the only ones. I just read a article that says over 100 million Americans have absolutely nothing in their retirement accounts. Now, in order to live a good life, Social Security is just probably not going to do it for you. Maybe give you subsistence level, but who wants to be a subsistence when you're in your 60s, 70s, 80s, maybe even 90 years old? You want to have a pretty nice nest egg for yourself. You want something that's giving you income, wants you giving you some capital gains so that you're growing your wealth, and you don't want to be dependent on your children or your great grandchildren or your grandniece that you've never even met when you're 95 or 96 years old. What a terrible thing that would be. So we're putting this together. This is my ideas. These are some of the things that I've found. I do a lot of research. I know an awful lot of analysts. And I'm putting this together so that you can make a better decision for yourself as to where to place your assets, what's going to work for you. Oftentimes when you put your money in a fund or in an ETF or something, really, you're the last one to know. You're not going to be dependent on anyone else. If you're working for a company, we're talking about you being able to maintain and manage your own portfolio. Yes, it's nice if your company's putting a pension together. That's great. If they make some mistakes, you have you're the last one to know, and you, of course, have nothing that you can do about that. So we're in the real estate business, and we want to talk about how the economy impacts the real estate business. Next week, we're going to talk about how to get started investing in the real estate business. But the economy impacts everybody. It certainly impacts our asset class, which is real estate. Now, we're not talking about going into any other asset class within, or sub-asset class within our asset class, but we're looking at very inexpensive entry level or the next plateau above entry level single family homes. We're talking about entry level homes, maybe even a condo. So I guess that wouldn't be a single family, but it could be a multifamily, but it's very, very unit friendly for families or singles, mom and dad, however it might be, so that we can go ahead and design a cash flowing portfolio for ourselves and develop a retirement account for ourselves. So this is my attempt to do this. You know, you're welcome to make comments. You can like the video at the bottom if you like it or not. But we're going to get started and let's talk about it. Now, I know there's a lot of negative press. There's an awful lot of negative media saying that the economy is just in shambles. Well, certain segments of the economy certainly are in shambles. You know, you have to know that the big regional malls are really, really having problems. Big box stores are having trouble. Retail is having trouble. A lot of hotels in the hospitality industry are having trouble. Restaurants, bars, nightclubs, venues, places to get married, you know, for have weddings, concerts, basketball games. Lots of these places are just having a terrible time. So if your dollar is tied to those types of assets, you know, that can certainly be a problem for you. Now, for rest of Americans, when we start talking about industrial and manufacturing, these are doing very, very well. And I bring this chart to you so that you can take a look at. This is from the Federal Reserve electronic data. And you can see right here, this is when the economy started falling apart in February, March. It just fell and just came straight down. And industrial production just came to a screeching halt. Now, that was done by the government. They did that with their lockdowns and attempt to put this COVID away. But it really impacted the economy. Every asset class just took it on the nose. But you can see since April, and this is indicative of the whole economy. So you can see this in manufacturing as well. This is why I use this chart, is that we started to bottom here. We had a bottoming process for really a very, very short time. So you're going to find this is one of the shortest recessions on record. It came along here, and then it started recovering. Now that is recovering is a long ways from recovered. We've recovered probably 55, 60%, as to where we were, which is pretty good in such a short period of time, because it really has happened within really 10, 11 months. When this first started, I said this would be one of the shortest recessions on record. And of course, it was. You can see where it stopped. And I think we'll be recovering by the time we get to end of this year, end of 2021, going into end of 2022. I think we will be recovered. Now, that's unless something crazy happens. So, who would have thought that we'd have a lockdown that would just stop the economy? So I call that a Mad Max event. Barring a Mad Max event, I think we're going to do pretty well. Let's go through some of the statistics. So this industrial production, what does that really indicate? Well, it indicates that the recovery is on track. It is on track per the forecast, that our forecast and our model is still working very, very well. We've talked about the fact it has confirmed the fact it's a historically short recession. And it gives us an indication that the economy, industrials and the manufacturing and a lot of the construction is recovering, and it's really poised for a much bigger springboard once we get the rest of the economy open. A lot of places, if you're in New York and have a restaurant in New York City, well, this is not a very good thing for you. Same with some places in New Jersey and Pennsylvania and some of the other states. The major markets are open, and this is where a lot of people are moving. So Florida, Texas, and Arizona are doing so much better than the other states. And of course, we're looking at a national chart here, so that's going to impact that as well. So we had a couple of really, really good indexes and data come out today. Came out this week. First part of the week, we had Institute for Supply Management came out for December. And it showed that we've got 8 months of recovery. Now, it had collapsed to 41.5 in April. Now, on these indexes, 50 is kind of the median number. So if it's above 50, the economy is expanding. If it's below 50, it's contracting. You don't really get a huge amount of movement around 50. So maybe you get a really good economy at 54, 55. This got really bad. It went down, it collapsed to 41.5. That was a very, very bad reading in April, and it has recovered. Here's the really good part about that is the December 2020, which we just got this week, has recovered to an amazing 60.7%. And even better is that new orders, things that are in the pipeline, are indicating where it's going to get even better, which goes along with the fact that we think the economy is going to do much, much better. But the new orders are up 67.9%. That is an incredible number. 16 of 18 categories are all reporting positive. And again, this is industrials and manufacturing. So fabricated metal, computer, electronics, transportation, chemicals, petroleum, coal, food, beverage, all these are doing very, very well. And they're getting new orders. So it's a very, very positive look. Now, the other thing that we want to look at here is the fact of M1 money supply. Now, we've talked about the fact that the Federal Reserve and the Treasury put in $6.8 trillion worth of stimulus March, April, May of 2020. That money became a historic. We got an extra $3 trillion added to our money supply. But the money supply went up, but we're getting no velocity because, as we're going to go through here, you're going to see that although we have lots of money to do lots of things, it kind of gets locked up in people's savings accounts and it's not moving around. It's the money velocity, not the supply, that really makes a big difference in the economy. I think we're going to be getting that soon, but at the moment, it's a little stagnant. So what's the difference between money supply and money velocity? Well, it's the fact that money is not moving as we talked about before. That is the huge difference. You need to have money supply. If you're going to expand, you have to have the money with which to expand and to pay for all the mortgages and all the bonds and get the cash out so that you've got these funds to fund all the different things that you're going to be doing. But what's happening is getting locked up in the savings. Now, here's from Federal Reserve personal savings rate. This is a very authoritative index. And savings rates in April Keep in mind, remember we got that $1,200 per person stimulus. Well, that money went right into savings. So we went to a savings rate around 33%. Typically, in the United States, we're saving between 5 and 9%. It's going to fluctuate up and down. As things get a little dicey, people have a tendency putting money into a savings accounts because they're not sure of the future. Look what happened here, 33% historical spike in a savings rate. That means that the Federal Reserve and the Treasury gave the money to everybody and they did not spend it. It went into the savings accounts and it's been working its way down since then, but we're still at a fairly high savings rate of 13.6%. Now, in order for the economy to really get going, we need to get the savings rate down to 5, 6, 7% where people are actually spending the money. And I've been told that if you use the velocity, if I went and bought a pizza, the tip I give to the pizza driver, he goes and puts that money into his gas and it is in velocity, so it's being turned over. That's what's happening when you have velocity, is that people are using the money. It could be the same money, but it's just turning over and over and over again. Now, this is a chart from Goldman Sachs. So Goldman Sachs thinks that we're going to be looking at, in the first quarter, which is where we're at, a 5% GDP. That's a very, very good number. Keep in mind, I don't think President Obama had a quarter that they did over 3%. I think Trump only did 1 or 2. Here we are. We're going to be looking at Q4 5%. We're looking at Q1 5%, and Goldman Sachs is thinking 8.5% GDP for the second quarter for Q2 of 2021. We just got a new stimulus, and I think that we could do even better than that. If you've been following my work, you know that when we put the $6.8 trillion into the economy in March, April, and May, it takes a long time to start working its way through the economy and get down to Main Street. It takes about 12 to 18 months. Well, that 12 to 18 months is just beginning when we get to here to the second quarter of 2021. And we're going to be getting not only that stimulus we just got, but we're going to be getting all this excess trillions of dollars of stimulus is also going to be coming into Main Street. And I think we could see a GDP of Q2 much higher. I think we could go to 10, which would be just an astounding figure. Now, what does that mean to you? It means that business is going to get very, very good. It's going to be very brisk. It means that virtually all sectors of the economy are going to do well. And you know that saying that says the tide raises all boats, and that's probably what's going to happen. So you got $6.3 trillion moving through the economy, and as this money starts coming in and you start seeing things get better, people are going to start spending, and that savings rate is going to come down, and we're going to see a much higher velocity of money, which is nothing but good for the economy. Now, also, we've got the dollar is changing. So we talked about, if you follow my work, we talked about the fact that the dollar could spike, go to 112. It spiked, went to 103 basically, and it has dropped ever since. Now, this is turmoil in the world when you get around here. 102.86 is where it spiked. That was the top. And when the US dollar gets strong, the rest of the world really has problems. So if you want a really good economy, you want a dollar that is down and depreciating. And that's exactly what we have. We have all the ingredients for really a boom, because when the dollar is strong, it means around the country, around the world, they have deflation. It costs them more money to buy goods that are expressed in US dollars. That's deflation. And now we've got inflation on ours because it's going to be costing us more money because our dollar is cheaper. And that's good for the rest of the world. But we're going to see inflation here. So let's just talk about that. January 4th, it's 89.75. So 12.7% drop. It's really good for our economy. It's good for business. However, how much of the 16.26 increase in the S&P for 2020 was a result of that 12.7% decline in the dollar? I'm going to say a significant portion of that increase was due to a declining dollar. So I would say you really need to talk to your financial advisors and take a look at your portfolio and see how that impacts you. Now, in my asset class, the dollar is going to affect us too, because it's going to bring inflation. And we're already starting to see this. We talked about how my cycle had predicted the March 2018 correction in housing. You can see it came down here. We talked about it would end in the fourth quarter 2019. It did. Came back up. I think we still have a small correction in front of us. I don't believe this is. We'll know in 2 or 3 or 4 months if I'm wrong, then this was that correction, and it was very, very minor, and we're off. And we should be right now in the accumulation phase. And you can see that. So those people who start buying properties, when we started talking about it, you can see that the prices have started to go up, and go up significantly. That is just going to be the beginning of a pretty major move. Now, here's what I'm concerned about, is that we've got copper up 25%, lumber a double, better than a double, up 116% in the year 2020, steel up 63%, and that is not just confined to international trade. We also see wheat and corn up, and we're one of the biggest agricultural producers in the world, but wheat is up 15%, corn is up as well. So we're seeing inflation for the first time in probably 2 decades. We are seeing inflation come into the economy, and you really need to start thinking about how this is going to impact you. Now, I did a video not too long ago. We talked about the fact of purchasing power, because at my age, we want to maintain our purchasing power, because we're going to live a lot longer. We're going to live to probably 85, 90 years old. And we need to have a pretty good life. Who wants to be living on the street if you're 90 years old? I talked about the fact that from the year 2000 to 2020, we had extremely benign inflation, typically around under 2%. But the purchasing power over that 20 years lost 50% of its purchasing power. Actually, it's 51.9% in benign inflation. So if you're starting to see inflation raise its ugly head, you really need to start thinking your assets need to be changed. And maybe you need to start going from financial assets to real assets like gold, silver, agriculturals, lumber, and of course, housing. Because when you see copper, lumber, and steel, what do we make houses out of? We make houses out of all this stuff, and look at the prices. So if the houses go up in value, if it costs you, 30 or 40% more to build a house, well, it's going to drag up all the existing homes, and prices of homes are going to go up. Now, we have had dollars go down. Now we're at 89. We've had them go down to 73, which would be an astounding drop in the value of the dollar. And that is still possible to do. So you need to really talk to your financial advisors and see how that works for you. Now, let me just move my picture here. You're going to see that when we got to 2020, we had the Federal Reserve was tapering their mortgage-backed securities purchases. But when they got into recession, they just stepped on the gas and they bought everything. And you saw that interest rates went down to next to nothing. We're talking 2-3%. That's a wonderful rate. I do not believe that the Federal Reserve is going to stop buying these things, but I do believe interest rates are heading up. So it would behoove you, if you need to do any kind of financing, you've got an open window here. It might be a really, really good time to do that. Now, during the bubble of 2005, interest rates were running around 6 and 7%, and prices of homes were skyrocketing. So interest rates are nice for payments, but they don't necessarily tell you that the market is going to get stopped out. Now, if it went to 10, 15, or 20, it would certainly change our marketplace. But we have to get up to a pretty significant number before you're going to stop the power that's going on in a shift from financial assets to real assets. And you really need to start thinking that this is maybe where you need to start parking some of your money. And we can talk about that later. Again, some of the big metros, Phoenix, Arizona, one of the big metros. Again, by states, it's going to be Florida, Texas, Arizona. These are the big destination states. These are also the ones that are open from the lockdown. And these are where you're seeing most of the appreciation. Let me go to the growth nationally. This is, again, the Federal Reserve electronic data. I want you to notice this incline right here. Now, the data is not in for November and December. I'm assuming it's going to be even stronger because of this steep incline as appreciation was going on. This is a national figure. So from October to October, it was up 7.9% nationally. A very, very stellar year. Typically, we're looking at, if we got north of 3% to 4%, that was generally a very, very good year for us. Here we are doubling that, 7.9% growth nationally. So where are we in the real estate cycle? Well, we've been talking about this. Here's the accumulation phase on our cycle. It's between here and here. 2023 is when I think we're going to start getting to the peak of the cycle. So we still have 3 or 4 years to make a fortune. And I think we're somewhere in here as to where we are in the very moment. But I think we're still in the accumulation phase, which means you're going to have an opportunity to buy properties at lower prices than what they're going to be 3 or 4 years from now. Now, I understand that prices have gone up. We just noticed that. We talked about the fact that nationally they went up 8%. For the last 15, 20 years, the best time to buy real estate was last year. But when you look at these, we're seeing here in the big markets like Florida, Texas, and Arizona, that both the price of the home and the rent are going up in tandem. And so that's telling us that it is not a sick market. It's a fairly healthy market because the rent to own ratio is staying fairly constant, which is a very, very good sign. So we're in the accumulation phase. That's where we are. This is the explosive phase. We'll probably this is like 2022. So that's maybe a year and a half away. And then I think we start seeing this curve get steeper. And I think we start to see we get a spike. So that's just what my prognosis doesn't necessarily mean that that's what's going to happen. But I think our market, my timing model has been fairly accurate. Doesn't mean it's going to stay. Again, you always want to talk to your financial advisor because what's good for me isn't necessarily good for you. Each one of us has different desires. But I think this is something that you really, really need to start considering is getting some of your money into real assets. The problem, of course, with going into gold and forest products and land is that there is no cash flow. One of the best real assets that give you cash flow, livable cash flow, of course, is residential rentals. And that's our market. And it's fairly conservative, but gives you a cash flow while maintaining your purchasing power. It's perfect for us retirees. And there's 100 million Americans that really need to start thinking that they are going to do this. And today is as good a day as any to start. So here we are in my market. Phoenix, Arizona led the market in across America's Maricopa County, not just Phoenix. This actually takes part of Arizona. Phoenix metropolitan area, Maricopa County. Actually, we're up around 15, 16, 17% for the year. Again, this stops in October. Our local statistics are showing 15, 16%. And rents went up about 13%. So if you were a landlord, it was a very, very good year for you. So this is just demonstrating what a great place for you to put money. What if you had to put 20% down? Just think 20% down and you got 12.7% increase on your 20%. That is going to give you a big, big return, 60, 70% on your money. It's hard, just do the math. I mean, it's hard to imagine. 3%, a 3% move on a 20% down is 15%. So this is probably around 65 or 66% in appreciation on a 20% because that's what leverage does for you. You leverage other people's money and you get the benefit of other people's money, but your portion is only 20%. So you leverage the whole property, you get 12.7% across the whole property, but you only have 20% of your money in there. And that gives you a huge, huge return. So big year for anyone who was leveraged last year. They did exceptionally well. So what would be the strategy? Well, the trends are continuing. I think the trends are going to do very, very well. I think you're going to see the economy do well if we can get to the point where we're no longer locked down. There's going to be a huge pent-up demand. I think you're going to see money come out of savings accounts. People are going to buy things. And they're going to do things, they're going to spend money, they're going to go to concerts, they're going to go to restaurants, they're going to go have weddings, they're going to dance and sing. And you're going to see a big velocity of money. You're going to see trends across the country. You're going to see the Rust Belt moving to the Sun Belt. You're going to see the major trends that have been kind of stalled are going to commence. So you can see Florida, Texas, and Arizona do exceptionally well in housing and business-wise. And for the next 6 months, I can see really no problems. Again, who would have thought that the government would have locked all the businesses and economy down? You know, so barring a Mad Max event, I think that the economy is going to continue accelerating. And I would say you're in the accumulation phase. I would say continue accumulating. Now, if you want to get hold of me, you can get hold of me at creatingwealth@westusa.com. If you want a consultation, I do this. This is my give back to you, is to give you a free confidential consultation. We do this in person. We can do it by Zoom if you like. Really, I give an hour away. This is not brain surgery, so you should be able to have this done within an hour. Almost everybody gets it done in 45 minutes or so. And you're welcome to call me. You're welcome to get hold of me. So you're welcome to reach me at michael@michaeldouville.com. But these other two will get to me really, really well. My very, very best to you. Thank you for listening to me, and have a good year. Bye-bye now.